Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing PetroChina's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. PetroChina is an oil and gas company. They are Asia's largest oil and gas producer. The company operates in all parts of the oil and production process, including exploration and production, refining, marketing, and transportation. 80% of this company is owned by China National Petroleum, and that company is a state-owned entity, so it is funded and controlled by the Chinese government. PetroChina is headquartered in Beijing, China, and was founded in 1999. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Vienna, Buenos Aires, Hong Kong, Shanghai, Singapore, and London Stock Exchange. Let's get started with the model. This is a large cap company, 151 billion market cap. They're trading at $52 a share, and they have 2.9 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. And that number peaked in 2021 at $13.5 billion. It was $12.1 billion in 2018. It dropped a lot in 2019, came up in 2020, then up again in 2021. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also peaks in 2021 at close to $15 billion. Revenue is the sales for the company, and that grew a lot from 2020 to 2021, over $418 billion. This is the company's income statement. All their financials are in their local currency. So I converted these numbers to US dollars on my Excel spreadsheet. So if you want to know what the number is in US dollars, you can just divide by 7. The top line is the revenue of the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. All the expenses related to pulling the oil, transporting it, marketing it, refining it, that's all part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in 2021. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. The payroll for the executive team is part of operating expenses. Gross profit minus operating expenses gives you your operating income, and that more than doubled from 2020 to 2021. They received $3 billion of interest on their investments. They paid almost $20 billion of interest on their debt, which is lower than 2019 and 2020, but it's higher than 2018. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example of something in this category is the gain on the sale of an investment. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is higher than 2019 and 2020 combined. The reason their revenue went up so much from 2020 was due to higher oil prices. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They did generate more cash flow in 2018 and 2019 than 2021. And they spend a ton in CapEx each year. In 2020, it's close to $35 billion US dollars. The company did spend in CapEx in 2021. It's just not reported on their financials for some reason. And they seem to issue a similar amount of debt as they pay down each year. They do have a lot of free cash flow remaining after the CapEx spend, so they do pay a pretty high dividend. Obviously, this free cash flow number is incorrect because it doesn't take into account their CapEx spend in 2021. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. Their revenue is at its highest point in the past 6 years. Since their revenue is pretty dependent on the price of oil, it's not going to move in a straight line. It's going to be up and down. But their operating cash flow is pretty steady, so it looks like they do a good job at managing expenses. The forecast is for their revenue to continue growing into 2023, then remain pretty flat after that. And the forecast is for their operating cash flow to remain pretty flat for the next few years. This is the equity section on their 12/31 balance sheet. They have $1.3 trillion of equity. They raised $183 billion from selling their business, and they profited $772 billion from running their business. Plus they have 308 billion in reserves. Let's look at the capital structure. 202 billion of equity, 75 billion of debt. They're 73% equity, 27% debt. And their net debt is 48 billion, so they do keep a lot of cash on their balance sheet. This blue line is their equity balance since 2015. So it looks pretty steady. And their debt balance also looks pretty steady. It has come down a little bit the past couple of years. And they seem to keep a healthy amount of cash on their balance sheet at all times. This is what you would like to see, the equity balance a lot higher than the debt balance. I gave them the whack on Simply Wall Street, 9.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 178 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $165 billion. We divide that by 2.9 billion shares. And we get a calculated stock price of $57. They're trading at $52, so they're trading at an 8% discount. It's a buy according to the model. The forecast is for their revenue to grow 5.6%, so I grew it by that amount for the next 4 years. That's how I got their future revenue estimates. On average, they convert 3% of their revenue into free cash flow, so I multiplied their future revenue estimates by 3%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $100. They're saying it's 47% undervalued. This is where the stock has been trading the last 5 years. It was over $80 at one point back in 2018. And then, like most oil stocks, it crashed around April 2020. That's the month oil bottomed out. And like most oil stocks, it's come up a lot since then. This bottom chart is the price of Brent crude. So it looks like before 2020, the stock pretty much tracked Brent crude. And the stock has come up a lot since 2020, but it's still trading well below its 2019 numbers. And you can see Brent crude has come up a lot well past its 2019 numbers. There seems to be a trend in a lot of oil stocks where they're lagging the price of oil by a few months. If you invested in this stock 5 years ago, you'd be down 28% today, while the S&P is up 92% in that same time period. The S&P looks closer to the price of oil. The S&P bottomed out in March 2020, and now it's trading well above 2019, while this company's growth since the bottom has been pretty moderate. So we may see a big spike in oil stocks in 2022. They pay a semi-annual dividend, so if you sum up the last 2 dividend payments, take that number and divide by the stock price, that gives you the dividend yield, which is 6.5%. That's 72% of their free cash flow, 67% of their net income. Their next dividend will be paid on August 8th. So you need to buy the stock before June 16th to get that August 8th dividend. Their dividend yield got close to 10% in the beginning of 2021. The forecast is for their dividend to be 7.1% by the end of 2024, which is a great yield. They have a pretty low beta, 0.76, so the stock is not too volatile. It's gone up 50% in the past 52 weeks, while the S&P is up 9%. The 52-week low is 35, the high is 58. And the stock is trading above its 50-day and 200-day moving average. Their employee count has been going down over the years. They had about 530,000 employees in 2016. They're down to 417,000. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $5,700 today. That's a 43% loss. 84% of the stock is held by private companies, 10% by the general public, and 6% by institutions. 80% of the company is controlled by the Chinese government, because the government of China controls China National Petroleum. Another part of China National Petroleum owns 3% of the stock, then BlackRock, BNY Mellon, and China Securities Finance Corp. Let's look at their financial ratios. They have an amazing PE of 10.3, that's stock price over earnings per share. A really good price to sales of 0.4, that's stock price over sales per share. And a great price to book of 0.7, that's stock price over book value per share. And they have a good price to free cash flow of 11.1. Let's look at their non-current assets. 1.5 trillion of PP&E, 265 billion of investments in joint ventures. They have 208 billion of right-of-use assets. These are assets they lease from other companies. 66 billion of intangibles, 12 billion of deferred tax assets. This will help decrease their taxes in the future. They have 8 billion of time deposits. This is similar to a CD. Let's look at their non-current liabilities. 287 billion of debt, 129 billion of asset retirement obligations. These are the costs to retire an asset. This includes removing equipment, cleaning up hazardous materials. They owe 123 billion in lease payments, 27 billion in deferred tax liabilities. This should increase their taxes in the future, and 9 billion of other. Their return on invested capital is 8%. They can cover the interest payments with their operating income 8 times. Their ROE is 7.3%, which is almost exactly the market median. And their current ratio is slightly below 1. Their quick ratio is 0.7. Let's look at their current assets. 143 billion of inventory, 57 billion of accounts receivables. This is how much money others owe them. 113 billion of prepaid assets. This is when a company makes an advance payment for a product or service they're going to receive in the future. They have 4 billion of financial assets at fair value through other comprehensive income. These are securities they hold that they label available for sale, which means they don't expect to hold these securities until maturity. 27 billion of short-term bank deposits and 137 billion of cash. Let's look at their current liabilities. 303 billion of accounts payable. This is how much money they owe others. 78 billion of contract liabilities. They have 76 billion of taxes payable. These are taxes they owe the government. 53 billion on short-term debt, and they owe 7 billion on their leases within the next 12 months. 7 billion in rents is roughly 1 billion US dollars. They generated 13.5 billion free cash flow in 2021. They have negative 6 billion of working capital, and they pay out nearly 10 billion of dividend payments. So it looks like they're going to be short. They may need to add some debt over the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 20 companies in the same industry as PetroChina. And if PetroChina has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They rank 7th in market cap at 151 billion. The average is 89 billion. They pay a much higher dividend than the average company. They invest a lot in CapEx, more than anybody else. And their price multiples are much better than average. Because if this company was in the US, their market cap would be double or triple what it is. But since it's in China, there's greater risk and people are less likely to drive the stock price higher. So they have an artificially low stock price, which makes their PE, price of sales, look really good. They generate a lot more revenue than almost every other company. Their 3-year annual growth rate is positive. The top 4 companies are negative. It looks like most US companies have declining revenue and most foreign companies have growing revenue. So to summarize, I have them trading at an 8% discount. I know lots of people are concerned about investing in Chinese companies. So there's plenty of other options out there. But if you invest in a company like this, you do get a great dividend and it's pretty consistent. And I think a majority of people that invest in this stock do so for the dividend, so they don't really care as much about the stock price, as long as they receive their semi-annual dividend. But the fact the company is 80% controlled by the Chinese government probably concerns a lot of people. I don't think it's much of a risk, because every government wants to make money, regardless of their political views. I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on a link in the description below. Thanks for watching.